The market cap of the Magnificent Seven is now the same size as the market cap of the entire stock market in Japan, Canada, and the United Kingdom combined. Also, the Magnificent Seven has a larger market cap, bigger than the GDP of every country in the world, other than China and the United States. So is this a bubble or the new normal? So this infographic and write-up from Kobeisei letter was accurate as of Jan 4th, 2024. So for those of you who thought that the Mag 7 couldn't rally any higher, the stock market went ahead to prove most of us wrong, with 4 out of the 7 names pushing for higher valuations in the first 2 months of 2024. So according to Investopedia, the Magnificent Seven is a term that has been repurposed to refer to a group of 7 high-performing and influential stocks, specifically in the technology sector. So these 7 companies are Alphabet, Amazon, Apple, Meta Platforms, Microsoft, Nvidia, and Tesla. So the genesis of this video idea was actually pretty interesting. So it was essentially triggered by a headline that I'd seen somewhere. So at Yardeni, the president of Yardeni Research recently made a remark stating that the Magnificent Seven isn't all that magnificent, suggesting that there was a fragmentation within the ranks itself. So my interest was further piqued when he published a short article on Yardeni Quick Takes with the title, 2 of the Magnificent Seven get Shanghaied. And if we attempt to decipher its meaning, it's probably due to their involvement with China by extension. So long story short, China is in a recession. Chinese consumers are buying fewer Apple's iPhone and also Tesla's electric vehicle, which made the 2 of them much more less magnificent. And these 2 companies are also facing much more competition from Chinese producers producing similar consumer goods. And therefore, their share price has also reflected this economic reality. So in this video, I will attempt to rank the Mag 7 based on a few in-house chosen criteria, such as the quality of the business and the strength of their economic moat, their past financial track record, future outlook and potential, and of course, most importantly, their current valuations. So just a disclaimer, this ranking exercise is not meant to be prescriptive, and please exercise your own analysis and judgment at the end of the day. So with that out of the way, let's get right into our framework. So let's look at these 2 key components when trying to determine their rankings. Qualitative versus quantitative approach. So qualitatively, how is the business doing? Are they fending off their competition well? Are they able to earn above industry margins? And more importantly, are they able to keep these profits? And how sustainable the profits are? Quantitatively, how have they been performing over the last 5 years? How are their financial ratios and balance sheet looking? If we do a modeling to project their future cash flows, are they trading at a fair valuation? So I believe many investors tend to look at these 2 factors as opposing ends, and they lie on a spectrum. Intuitively, if you think about it, a low quality business will tend to trade at a cheaper valuation and vice versa. So that's why they are on opposing scales. And that's what I'll try to establish when we are looking at the individual Mag 7 names. So I'll be giving each of them a score of 1 to 10, with 1 being the lowest and 10 being the highest or the best. And it will also be a score blended across different factors, and this is how it will generally work. So I'll be placing more emphasis on the quality of the company based on the simple 80-20 rule. So 80% of the score will be determined by the quality aspect of the analysis, while 20% will be determined by the numbers and valuations it's trading at today. So in this specific 80% breakdown, we will take into account the consistency of their margins, comparing it to industry averages, and also, more importantly, our opinion of whether the business has a wide, narrow, or even no economic moat. Essentially, this is the long-term view of whether the business would be disrupted in the next 5, 10, or even 20 years. So in the other 20%, I think I'll keep it simple by using a blended approach, using various valuation methods such as PE, forward PE, price earnings growth, and even a discounted cash flow. So now, let's go down the list. First, let's take a look at Alphabet, the parent company of Google. So intuitively, we would expect Alphabet to score very high on the quality aspect. And Alphabet currently owns 2 of the most important properties on the internet. search and YouTube. They essentially have a brand monopoly, and when the company's product is used as a verb, I think it speaks volumes of how strong and recognizable the brand is. They benefit immensely from network effects, particularly in their search engine and also advertising, creating a perfect loop from data collection to training the algorithms to improving the user experience, and most importantly, delivering the right results to meet the user's need. It's a self-reinforcement cycle. So their current scale has also enabled them to reap huge advantages, specifically on creating extremely high barriers to entry, enabling them to monopolize the search market even until today. However, the outlook of Google search has started to seem murky with the proliferation of ChatGPT and large language models alike at the end of 2022. So we have made a separate video outlining the risks and concerns about the future of Google search, and you can head over for a more detailed explanation. So search is currently under intense scrutiny, given the potential shift in how users retrieve data in the coming future. So before GPT, I would have given Alphabet a solid 8. Right now, I think we can only settle with a 6 for quality. So for Google's current valuations, I believe it's undemanding. In fact, out of their Max 7 counterparts, regardless of how you slice and dice it, whether is it on a forward PE, on a PEG ratio, its valuations is one of the lowest out of the 7. So using our in-house investing tool, the True Value Finder, we estimate the intrinsic value of Google to be right between $160 to $180. Therefore, we think that Alphabet deserves an 8 for valuation, 8 being pretty attractive, which means that Alphabet has a blended score of 6.4. Second, let's talk about Apple. So Apple was always the darling of Wall Street, maybe because of Warren Buffett, but it has been one of the most respected and well-run enterprises the world has ever seen. Brand monopoly, customer loyalty, high switching costs, barriers to entry, economies of scale. You name it, Apple has it. So the problem today, Apple's complicated relationship with China. So not only do they rely on China for their production capacity, but they too rely on their domestic demand, which makes up around 20% of their sales. So considering the state of global affairs currently, Apple is balancing on very tight rope. Just recently, it was announced that Apple sales in China dropped 24% in the first 6 weeks of 2024 compared to the same period in 2023. So the iPhone market share in China has also slipped to 16% in 2024, falling to 4th place compared to the 2nd place in 2023 when they had around 19% market share. So it's true that Apple is still able to charge premium prices for their products due to the perceived brand quality. But this important Chinese pie is shaking the entire boat. So for this, I will accord a 7 to Apple's quality. So from a valuation perspective, Apple is definitely trading at a premium valuation when compared to the overall large cap index. But really, to what extent is it justified? So according to our calculations, we think that Apple's IV should be right around 160 to 170. And even after their recent fall, it's still right around fair value. Therefore, I would think that a score of 4 would be suitable, which means that Apple, alongside Alphabet, also has a blended score of 6.4. Third, Microsoft. So Microsoft is probably one of the strongest businesses we have seen in this decade. King of software, a portfolio across hardware and software, gaming, cloud, and even artificial intelligence now with ChatGPT and Bing. So some will see investing in Microsoft as being equivalent to buying into an ETF, exchange traded fund, due to its diversified nature. Microsoft is always on the offense, from the Blizzard acquisition in the gaming division to the partnership with OpenAI and going after the launch of rival tech companies like Google. I think there's not much to argue here. Microsoft's quality will be a solid 9. So why not 10, you might ask? I guess it's just the Asian gene in me. My parents always told me since young, you can do better. So let's hold back the last point so that Microsoft doesn't get too ahead of themselves. On the valuation front, we think that they might be slightly overextended. So I understand why everyone wants a piece of this pie, which explains the premium valuation they're currently trading in. Therefore, we'll give Microsoft a valuation score of 3, bringing its blended score to a 7.8. Fourth, Meta Platforms. So both Mark Zuckerberg and Meta Platforms had been through a wild ride. Their recent run-up came on the heels of a 75% decline back in 2022 from its peak due to a myriad of concerns, from stagnating growth rates to margin destructions to frivolous spending on AR and VR, and more importantly, a sheer disregard for shareholder value. At least, that's what most bears were arguing for in the better part of 2022. So Zuckerberg has came out to clarify in multiple earnings call that a majority of their investments are into their AI capabilities of the legacy business, namely Instagram, WhatsApp, and Facebook, iterating and building on their existing ads architecture. And more importantly, innovating their way out of the new Apple updates, which heavily restricted their ads targeting. So moving forward, we are very optimistic about Meta's continued push for innovation in their discovery engine and also their open source large language model that uses AI to generate text, images, and codes, essentially equipping their merchants and customers alike with the tools that they need to level up their reach and also their scale. At Meta's current stage, I think 7 is a conservative estimate of their quality. On the valuation side, we think that Meta is worth right around $420 to $450. Hence, tagging them with a score of 3 at their current price tag of near $500 per share, bringing Meta's blended score to a solid 6.2. 5. Amazon. Fundamentally, we see Amazon's business turning around the corner, coming out gradually from its investment cycle. So we look forward to Amazon continuing to optimize their cost structure and exit from the heavy capex spending era. So logistics is an extremely tough business, and Shopify acknowledges that too. They have completely sold out Shopify logistics to Flexport last year. However, from a moat building perspective, Amazon has only one goal in mind, which is to satisfy the current customers. Therefore, given its current positioning, Amazon has managed to amass some of the highest quality customers with Amazon Prime, providing top-notch experience, enabling them to maintain their lead in e-commerce and grow their advertising arm aggressively. So let's also not forget about the crown jewel, AWS. So Amazon Web Services enjoys a durable and profitable network effect. As more applications are built, the system attracts new developers, as that's where customers and data are at, which then generates more data and application, creating more value for customers. So this network effect is further compounded as they scale and retain the customers due to the high switching cost. So given the multiple engines of growth, from e-commerce to advertising to cloud to logistics, each compounding on one another's strength, we do see Amazon as having a very strong foundation for the growth in the decades ahead, awarding it a quality score of 8. So when looking at Amazon's valuation using a sum of the parts model, we do find Amazon competitively priced with a small margin of safety at current valuations of right around $170 per share. Hence, we do think that Amazon is fairly priced, giving it a valuation score of 6, which means that its blended score is sitting at around 7.6. Number 6, Tesla. So like it or not, I will end up offending one group of investors by having an opinion on this company. So I'll tread extremely carefully. So Tesla has had phenomenal success and execution over the last few years. So the stock price aside, I think the company has executed superbly. So to understand Tesla's valuation today, it really depends on how you see the future of the company. On the bearish side, if you view Tesla as solely a car company, today's valuations might look a little lofty, as they sit at a price to sales of around 5 to 6 times, while comparable companies like Toyota, Ford, and GM, they have a price to sales ratio of 0.3 to 1 times. However, if you're to ask the Tesla bulls, they will be showing you the other side of the story, where the car is essentially just a Trojan horse for Tesla to sell you something better, like full self-driving, to energy, to even robotics in the future. Arguably, Tesla is right at the start of multiple S-curves, as they claim. So while I do believe that Tesla is working on exciting projects and Elon Musk is someone whom we wouldn't want to bet against, but I still prefer to err on the side of conservatism. So for now, it seems like many of these exciting projects stay exciting, but its potential profits require quite a bit of imagination. So I do see the strength of Tesla's brand advantage, charging infrastructure, and more importantly, its manufacturing capabilities. So a quality score of 6 should be fair. However, on the valuation front, that's really up to debate. Like previously mentioned, it really depends on where you see Tesla's future is. So to us, Tesla definitely feel a little too pricey for our liking, and considering the circumstances of the Chinese supply chain, demand, and competition, we don't think we can justify a high valuation for Tesla here. Therefore, we think that they would bring a valuation score of right around 2, bringing its blended score to be 5.2. And last but not least, number 7. It's everyone's favorite in this AI boom, NVIDIA. So when talking about NVIDIA, you'll probably meet two different groups of investors. So one group completely writes them off as they cannot make sense of their current valuations using a rear view mirror when looking at their historical earnings. Meanwhile, the other group is extremely optimistic about the future of AI, GPUs, and the software-hardware integration of NVIDIA, crowning it the iPhone moment for NVIDIA. So truth be told, I'm somewhere in between. So I don't think we should throw the baby out with the bathwater. So I've watched and listened to many intelligent investors making their case for investing into it today. So reasons ranging from superior hardware and software integration to phenomenal foresight in their forays before their competitors into both crypto and AI, and of course, how groundbreaking and instrumental this AI wave would be in the coming decades. So the bigger question is, how sustainable the pace of chip buying can be, and also, will the total addressable market be big enough for NVIDIA to grow into to justify today's valuations? And on top of that, require a good rate of return. So in terms of quality, I think there's no doubt no competitors actually come close to what NVIDIA can offer, giving them a solid 8 on the quality aspect. For valuations, however, it's really a wild guess. We do think that a large part of their valuations were carried by momentum. And right now, it's too tough a pill to swallow. Therefore, I think that investors should be cautious when entering at today's valuations. So personally, I want to give it a 1, but let's settle with 2, bringing NVIDIA's blended score to be 6.8. So after listing company by company, this is the final ranking of the Max 7 based on the blended scoring system. So with Microsoft being the first and Tesla being the last. So feel free to agree or even disagree in the comments down below. But to our viewers who are extremely bullish on Tesla, and I know that there's a large group of you out there, hold your horses. I can already feel the criticisms coming our way. FBI, open up! So here's the thing. If to only judge based on valuations and quality, that is just 2 dimensions. So to further expand the discussion, I'll introduce a third dimension, which is the company's potential. Or some of you might actually call it the wow factor. So I'll basically apply a multiplier to the score, which acts as some sort of a bonus to give you a more complete expectations of the company's outlook. I've applied the highest multiplier to both NVIDIA and Tesla because they have the most exciting outlook and potential out of the Max 7 bunch, from full self-driving to robotics to even AGI, Artificial General Intelligence. That said, I would just like to remind everyone that this ranking is not prescriptive and it is just my opinion of the company in today's market environment. And of course, potential will stay as potential if they're unable to execute and convert it into profits and cash flows in the future. So if you're interested in how we get our intrinsic value calculations of these different companies, Piranha Profits has a powerful tool that helps you discover the right prices to enter into these stocks. So check out our True Value Finder to find undervalued deals in the link below now. So this is CK from Piranha Profits signing off. Until next time, keep winning.